As we sit here today, we are recovering a little bit from the massive sell-off we've had over the last week or so. Once we hit all-time highs, the market has, as we anticipated, the volume and the volatility has picked up, and now we're seeing a somewhat of a correction. But let's put what's actually happened in the last week or so into context.
Yeah, the first handful of trading days in September, the S&P 500 was down about 5%. So based on the past 4 months, that is a massive sell-off. But obviously relative to March, that's absolutely nothing. But this rally since the March 23rd lows, being up 58% at the largest point of the rally there, basically no volatility to speak of, no big dips or drops. And then, first handful of trading days in September, this volatility flared up almost out of nowhere. And a lot of the stocks that were the biggest winners year to date were hit pretty hard. And a lot of the ones that weren't big winners year to date, it was almost like nothing happened. So
Right.
It was a very unique sell-off.
Yeah, we saw Tesla, Apple, with the stock split issues, and Tesla being potentially included in the S&P as some of the reasons why that stock went up so fast, but it came down really fast as well. What's going on that would create this tech sort of correction here?
Well, we've spoken in prior videos about how the market structure and the technicals, particularly related to some of these big tech names, is becoming very, very unstable. And there are a number of things we mean by that. But when you see a stock like Tesla that for the first 8 months of the year was up almost 500%, and you have to ask yourself how much of that was justified by improving fundamentals. They are regularly making a profit now, regularly the past few quarters. Got a lot of business momentum. They've benefited a lot from COVID. But, if you say, well, 4/5 of that is due to the fundamentals and the other fifth isn't, well, that's a huge amount of downside risk if you're just off a little bit. There's some frothiness, and there's potential for a lot of frothiness. And we've seen a big shift in how retail investors are participating in these darling stocks, these tech stocks, particularly through options buying. And that options buying can have a pretty significant impact on volatility in these stocks. So something like what we saw in early September, that will probably be sort of the new norm as long as these trends persist.
Yeah, so let's for the viewers, let's talk a little bit about the options market and how this works and what actually is going on, because we've seen a few alarming things that give us signs that we're nearing some type of blow off top or irrational exuberance, because now we have call buying in excess of 50% by retail traders. But let's just explain how call buying works and what sellers of calls have to do and how that affects stock prices.
So if I'm a retail investor who's getting into buying call options, why does that seem attractive to me? Because say, for example, on the day that we're recording this, Tesla's up $23 a share, so about 5%. I can buy a call option on Tesla. So the out of the money call option that expires in a month, that's up almost 50% today. So if I want to magnify my potential gains, instead of just buying Tesla, that's not sexy or exotic enough. I should buy the out of the money call option. And then I basically leverage my potential gains 10 to 1 or so. And basically what that call option is, I put up a little bit of money up front. And within a month, when that option expires, if the stock price is above the strike price or the exercise price, I make money. And as the stock price goes up and it gets closer to that exercise price, the price of my option goes up. And so I can sell it and make money.
And these are extremely risky types of investments, and the magnification of the profit can also magnify the losses. And most people use these for hedging, and they're used by institutional investors or highly trained speculators. But now we're seeing massive amounts of retail investors use them through apps like Robinhood and other online trading apps that have sort of been democratized, and they're significantly impacting prices of stocks.
And how that feedback loop happens. So you take, once again, not picking on Tesla, not for any particular reason, but Tesla call option volume here the last few months it's been about 40 million contracts a month, and compared to an average prior to the last few months of about 8 million. So a significant increase in call option volume, and we know it's call buying. And so when you go into your account and you buy that call option on Tesla, well, there's a market maker on the other end. And this is where the stock price gets impacted. So this is where you get the knock-on effects. So there's a market maker on the other end of that trade. And that market maker, the first thing they're going to try to do is look and find somebody who wants to sell this call option. And then they'll just match up the buyer and the seller, and they're done. But we know nobody's selling call options on Tesla. So instead, the market maker looks and says, oh, I can't find anybody to sell this option to you, so I need to make it myself. So now that market maker is potentially on the hook. If that option goes up in value, they're potentially on the hook. So they need to hedge that exposure or reduce their risk. And how do you reduce that risk? Well, they buy the stock.
Let's talk about what happens when this actually unwinds, because it's almost like you're coiling up a spring as more and more people are buying call options, and the option sellers have to cover, and the number of contracts from retail, which we're defining as 10 contracts or less, is just blowing through the roof. So when this unloads or unwinds, it's going to be vicious, correct?
Yeah,
Or could be vicious.
It could potentially, yeah. It amplifies the move on the upside, and it also amplifies the move on the downside. So you see some type of a technical event, like Tesla gets snubbed from the S&P 500, and for a fundamental reason, the stock should be down when that happens, but it shouldn't be down over 20% in a day. That is because of the instability in the market structure. And if this is just a few stocks that are on the brink of bankruptcy and the options are cheap, that's one thing. But we're not just talking about one stock here. We're talking about all of the darlings, all of the MAGA F names that represent about 25% of the S&P 500. So this impacts everybody now. This type of dynamic, magnifying the gains on the upside for the S&P 500 and magnifying the losses on the downside.
During this tech correction, what happened to the rest of the market? What happened to value stocks? Was this the actual start of the waiting for Godot rotation here into value?
No, so what you saw was value stocks were down as well. Stocks in the S&P 500 outside of MAGA F, the other 495, they were also down, but far less. Mm-hmm. They were, down somewhere in the neighborhood of 2%, whereas other areas of the market, the growthier areas of the market, these tech names, they were down much more than that. 8% or more. Tesla was down over 30%. So that's sort of the dynamic. We've talked in prior videos about how value stocks have underperformed growth stocks by the largest margin ever. And what are the ways that discrepancy can rectify itself? And one of the ways is, this market structure becomes so unstable, and these growthier areas of the market sell off. Everybody's selling what they own. Options dealers are hedging on the way down or reducing their hedges on the way down. And you just have the unloved value, high quality dividend paying stocks outperform just by losing far less on the downside.
As I think we're getting more and more news around the potential for a vaccine, what do you see in terms of the growth versus value trade? Or what have we been talking about internally about how that might impact the growth versus value trade?
Yeah, so when you look out in the market, you take the subset of work at home forever stocks. They're up huge this year and basically at all-time highs. And then you look at the subset of vaccine stocks, and they're up huge this year and at all-time highs. And you think, how can both of those things be right? If the vaccine stocks are right, and we're going to have multiple effective vaccines ready for mass distribution, potentially by year end, then people aren't going to be working at home forever. So those two things can't be right at the same time. And the opportunity, the stocks that have missed out on this dynamic are more of the experienced stocks, the stocks that they sold off during this COVID crisis for fundamental reasons. I mean, people aren't coming into stores, they're not going on trips, so on and so forth. But as long as they're not going bankrupt, they're using this as an opportunity to reconfigure their business models. And then, we do get an effective vaccine and things get back to normal. That's the opportunity, because those stocks are, as we saw in early June when the reopening just started, those types of stocks can go up 30-40% in a week or two, if there's news about a vaccine. So that when you look at the S&P 500 near all-time highs, you look at this instability in the market structure, a lot of the mega cap tech names, and you think, what's the opportunity here? What's left? Those are the types of areas: the value stocks, the unloved stocks, the experienced stocks. That's the biggest mispriced risk in the market at this point, is the upside risk from a vaccine.
What's priced into the market, and how much impact is that going to make if we don't get any type of stimulus before the election?
So if you don't get any type of stimulus before the election, probably shouldn't be too big of a deal, because the expectation is after the election, stimulus will come. Deficit spending is a bipartisan issue, but maybe not within 50 days of the election. So regardless of the political outcome, we think there is going to be more stimulus, not just here this year, but as we think out the next 1, 3, 5 years. Deficit spending, fiscal stimulus is just going to be a bigger and bigger part of U.S. economic growth. So this stalemate, it may keep the market from moving significantly higher pre-election, but we don't necessarily view this as a big downside risk pre-election if the stalemate continues.
Quick election update. Any changes to the information we've shared recently on Democrats versus Republicans and likelihood of a sweep?
The probability of a Democratic sweep is rising again. So the Republicans made a little bit of a comeback there through late August, but recently, particularly in the Senate, which is the only race that's sort of up for grabs at this point based on the betting odds, the Democrats have rebuilt their lead a little bit. So, pretty similar to what we've been seeing. The odds haven't changed too significantly.
And then the news today, I think the survey was the Fed will be on hold until sometime in 2023, which is kind of funny because I don't know how they picked that time frame, but what's the reaction to that? The market seems to sort of like that idea.
When we came out of 2008, 2009, the market was actually thinking the Fed would hike rates in late 2009. They were thinking that all of this deficit spending, all of the economic fiscal stimulus that we had to do during the global financial crisis, the Fed's expansion of their balance sheet, would result in inflation and they would have to raise interest rates. Now the expectation is, they're never going to have to raise interest rates. And if you have even longer term expectations that interest rates are going to stay low, that just has the effect of bidding up the prices of other assets like equities. And so, it's kind of a known that the Fed is going to be on hold basically forever. The traditional monetary policy tool of raising and lowering interest rates, it's, that's so 10 years ago.
Okay. Yeah.
Now we're talking about asset purchases. We're talking about MMT. Those are the things that the market is going to be focusing on to move the needle.
And in our research, we've done a lot of research on negative rates. Do we think, what's our updated probability on the Fed actually going negative versus just pegging the curve?
It seems highly unlikely that in the US, the Fed will use negative interest rates. A lot of academic research has come out saying that negative interest rates in general have not been effective overseas, where they've been used more frequently for a longer period of time, and that they would be even less effective and maybe even detrimental to economic growth in the US. So, negative interest rates, highly unlikely in the US. Also, one thing that this crisis has taught the Fed has just reinstilled the idea in their minds that they have other tools that are very effective. Asset purchases, purchasing corporate bonds, so on and so forth. So the Fed doesn't feel the need that they need to continue lowering interest rates when they have plenty of other tools that clearly are effective in raising asset prices.
Right. Mike, thanks for joining, and we'll look forward to the next update.